Good afternoon, guys. Good afternoon. Hope you guys are doing well. My name is Nkateko, brought to you by Japanomics Tutorials, and today we'll be covering balance sheet, right? So I've asked in the group if there's anything that you guys need assistance with, or I should make a recording on, and most of you guys were saying balance sheet. So hopefully today we are going to clarify everything, every problem that you guys encounter in the balance sheet and make it easy for you. So, first of all, right, balance sheet is also called statement of financial position, right? So, every time when you have to write a balance sheet, like if they ask you to write a balance sheet, you have to mention up there that the statement of financial position at forget date lapaya because I think you get a mark for that one. So never forget that one. Don't be confused. Balance sheet is also known as statement of financial position, right? So what is balance sheet? Balance sheet, right? It shows companies' financial status at a specific point in time, right? um if a potential okay, I'm so sorry for the mistake there, the typo. If a potential or already existing investor wants to assess the company's asset or liabilities, right, they refer to this statement. So if you, or like, let's say you are an investor, right, and then before you want to invest in a company, you want to see what's okay, like what is the state of this company, what kind of asset or how many the value of the assets that the business has or the company has. You have to refer to this statement, right? But we'll discuss on that one later on. We are also going to look at the notes, each and every note that is included in the balance sheet, right, and try to explain to you to what's going on. Okay, so firstly, one thing that you have to understand that is very important, is very imperative for everyone to understand, right? As the accounting equation, I actually highlighted on this one, on the previous class that we had last week. However, I'll repeat again. Assets as well to equity plus liability, right? So first of all, you have to know what are assets. Assets as is what the business owns, right? Liability is what the business owes, and then equity is just the difference between the assets and liability. In what sense? Like, let's say you have assets that are worth 50,000, right? But with a 50,000 you are owing 40,000. The 10,000 difference, it belongs to the owners. That's like as the equity, right? Okay, I made an example here. Imagine you own a truck shop, right? The money you have in the bank account, your stock, and the fridge you bought for the shop are your assets, right? The money you owe to suppliers is your liability, and what is left, or your profit or investment, is your equity. Okay, so like, just always refer to this example if you get it confused by any chance or anything like that. Okay, there's another example here. Chabo starts a business with 50,000 cash. He buys equipment for 20,000, stock for 10,000, and keeps 20,000 in the cash in the bank. So sorry. He also takes a loan of 15,000. Okay, here I was only able to account for the first part of this transaction. Just give me a second. I was only uh able to cover the first part of this transaction up until this point, right? So firstly, he has 50,000 cash, right? Okay, and then he started a business with 50,000 cash, right? He bought equipment for 20,000. So equipment is asset, right? Equipment is asset. It falls under fixed and tangible assets, right? So you have to record there. It's okay. We have an asset for, excuse me, guys. You have an asset for 20,000, right? And then stock for 10,000. Now it's stock. What does stock belongs? It belongs under current assets, right? It's also part of asset, remember? And then we also have 20,000. The 20,000 is in cash, like is in the bank, right? So it falls under cash and cash equivalent. So if you were to add up all of this, right, as 50,000, so basically the whole of 50,000 that was invested in the business, right, or that was used to start up a business, now we want to see what happened to it. Okay, he invested 50,000, right? Okay, what did he do with the 50,000? Firstly, he bought equipment, he bought stock, and then he kept some of the cash right in the bank. Okay, so if let's say if you are a potential investor, right, and stuff like that, and you want to see what's okay, how does how much does a business o- own? Like how much is there in the business, right? You're going to refer to this statement and be like, okay, this guy has an equipment for 20,000, has a trading stock for 10,000, and also have cash for 20,000. Okay, so now that will help you to make a financial decision or assess the financial state of the business. Okay, so to back to the thingy to the accounting equation, we have equity of 50,000, liability is zero, and then assets as 50,000, right? All in all is 50,000. Made calculations here, right? So assets is equal to equity plus liability. Therefore, the accounting equation stands, it balances. Okay, here we have Martin. He also takes a loan of 15,000, right? So if you take a loan, right, there are two accounts that are affected. If you take a loan, what do you receive? You receive 15,000 in your bank account, right? What is bank account? It falls under asset, right? So your asset is gonna be 15,000, and then liability. Remember, a loan. Excuse me, guys. A loan is a loan is a liability. Therefore, you're gonna record with this 15,000, and then back to the accounting equation. Under assets, we have 15,000, and then under liability, we have 15,000. This transaction does not concern equity. Yeah, but we see, like as you guys can see, both sides balances. Hopefully that helps you. But now let's get straight to what you call to activities. I mean, not activities, but to the balance sheet. Okay, hope everyone can see here. So we're just gonna start everything bit by bit. So we have um we have assets here, right? Assets, remember this is what the business owns, right? Assets are divided into two. We have non-current assets and we have current assets, right? So I'm just gonna quickly explain what are non-current assets and what are current assets. So non-current assets refers to the assets that cannot be or are not going to be converted into cash in the next 12 months, right? Here we're talking about your fixed or tangible assets. So the moment the business buys a vehicle or a landed building, they're not planning to sell that building or that vehicle in the next 12 months, right? 12 months. That's why it's included in the what you call in the non-current assets, right? However, it's a different story if a business at selling cars, like the nature of the business is to sell cars. Let's talk about BMW. Let's say, again, you have a company for BMW, it specializes in selling cars and stuff like that. So if the business buys a 3 Series, right, it cannot be recorded under non-current assets, right, because they are planning to sell that car in the next 12 months. Like, it's the nature of the business is to sell cars, so therefore it's going to be recorded under inventories. Just for you to know that one, right? It's just, I doubt it's gonna be examined, but it's just for background information, like just for an extra knowledge, right? So I explained what is non-current assets. Now, what is current assets? Current assets are those assets that are going to be converted into cash or are already in cash in the next 12 months, right? So they're going to be converted into cash in the next 12 months or are already in cash. We're talking about your inventories, trade and other receivables, and cash equivalent. Okay, but it's fine, again. Let's talk about your fixed tangible assets. So your fixed tangible assets, we have a note actually for this, right? We're just gonna move to the next page. Okay. So here's what's going on here. This is note 3. This is note 3. So what is going on here in note 3? Okay, we can see that we have four tangible assets that are thinking that are associated with a business or with a company. We have land and buildings that are all included into one, but as you go further with your educations, if you're gonna continue with accounting, you're gonna have to exclude this one. I mean, you're gonna have to differentiate those ones. But for now, Jay, land and buildings they go together, and then we have vehicles, we have equipment, right? Okay, so remember, guys, in our balance sheet, right, we are only interested in knowing the carrying value of our assets, right? So for us to get the carrying value of our assets, we have to do this now to calculate the carrying value. So we have cost. The cost here, you're just gonna put the cost as it is. We have accumulated depreciation. What is accumulated depreciation? Accumulated depreciation as all the depreciation an asset has occurred for a period that we had it or we held it, right? So if we had a thing, if we had a vehicle, right, for 4 years and it has been depreciating for like by 10,000 for each and every year, that means again our accumulated depreciation is going to be 40,000. So what happens is that we are going to add all those depreciation that we have incurred for the period that we had the asset for, right? And then if you take your cost and minus your accumulated depreciation, you're gonna get your carrying value at the beginning of the year, right? Remember, this is at the beginning of the year. Okay, but it happens that a business buys or sells assets during the year, right? Now, how do we account for that? And then we move to what you call this segment of movements, right? So additions at cost. Now, additions at cost it refers to a situation whereby a business uh, um, acquire more assets, right? So now we have to account for it here. Remember, you account for it at cost. If a business buys what you call a land and building, maybe for 50,000, you're gonna have to put your 50,000 here. Like it happens. I mean, that applies to each and every asset that is um affected here in this transaction. I mean, in this note. And then we have disposals at carrying value, right? Guys, every time, right, an asset is sold, right, it is recorded at the carrying value at that the carrying value at that point when it's sold, right? Remember, you had a carrying value at the beginning of the year, right? If an asset was sold during the year, you'll have to calculate uh what was the carrying value when the asset was being sold. Let me just make an example real quick, right? Let's say we had an asset, right? It was 50,000. Okay. The carrying value, this is the cost. The accumulated depreciation at the beginning was let me say 30,000, right? And then how do you calculate it? Is 15% on cost. Okay. Let's say now we sold an asset during the year, right? Maybe around June, right? And our year starts at 1st Jan and ends on 31st December. So now let's say now we sold an asset at June 31st June, right? So we'll have to calculate again the depreciation for the time the asset stayed with us during the financial year. So it's going to be January, February, March, April, May, June. So that is 6 months. So what we're gonna do is we're just gonna take the 50,000 times 15% times 6/12, and then it's gonna give you, just give me a second, let me calculate real quick. 50,000 times 15% times 6/12. So it's gonna give you it's 30, I mean it's 3,750. That's your depreciation for this year. So if you add this depreciation, 30,000 plus this one, you're gonna get let me write it here. It's gonna get 33,750. And then if you say 50,000 minus 33,750, you're gonna get 16,250. So this right here is your carrying value at the disposal, right? So if now the vehicle was sold at 31st June, right? The amount that you're gonna have to record here is gonna be 16,250. Hopefully that makes sense, guys. But more to it when we are doing the examples. Not we're not going to do the examples in this lesson, but we're gonna hold another lesson during this week. So if you are interested, make sure that you join the group and join the lesson. Like we're gonna discuss on that one later on. But yeah, hopefully everyone understand um this segment of what you call the disposal at the carrying value. Now depreciation for a year. Now this is where we lose a lot of marks now, guys. For depreciation for a year, first of all, you have to understand what is depreciation. Depreciation is an expense, right? The expense that is incurred when an asset loses value. So we are only interested in the depreciation for the period the asset has stayed with us for the during the financial year. So we usually differentiate them. We have old, we have new, we have sold, right? For old, right, this one is 12 over 12, is fine here, it should be easy. And then we have new now. We are when we buy an asset during the year, right, we are only going to calculate depreciation for for the months that asset has stayed with us. Let's say we bought an asset at on 1st of July, right? So the asset stayed with us and our year ending is on the 31st December. So the asset stayed with us for 6 months. So we're only looking for depreciation. The asset has stayed with us. So when you calculate it, you're just going to put your cost, depending on which method that you are required to use, you're going to put your cost times the percentage and times the amount of months the asset has stayed with us, right? And same thing with sold. So we are only interested in the depreciation the asset stayed with us before it was sold. So if an asset was sold maybe around November, 31st November, and we have a year ending of 31st December, that means again the asset has stayed with us for 11 months. So when you calculate depreciation, you have to take that into account times 11 over 12. So hopefully you guys don't face problems or you don't get it confused when you get to that part where now you have to proportion the months the asset has stayed with us. Okay, so now cost at the end of the year. uh this one is not usually understood by many people. Cost at the end of the year is going to be cost sorry it's going to be cost at the beginning, right, plus the additions at cost minus, don't make a mistake and minus the amount that you got here. No, remember this was at the carrying value. We are only interested in the cost here. So let's say now that time again we said our asset was 50,000. You're going to minus the cost of the asset that was sold. Let me write it down here. Hopefully you guys are writing down notes there so that you remember this when you're studying. So it's the cost of asset that was sold, right? And then that's how you get this cost, right? And then what about this accumulated depreciation? A lot of marks are here, guys, and it's easy to lose marks here. So for this accumulated depreciation, you're gonna take the accumulated depreciation from the beginning, right, of the month, and then you take the depreciation that you calculated here. And I forgot to to do this segment, but I'm gonna go back to it. And then you take the depreciation that you got for this. Oh no, I think I did for this that you got here for depreciation for the year, right? And then you minus the depreciation of an asset that was sold. Hope that makes sense. If we minus the depreciation, the accumulated depreciation of an asset that was sold. So let's say now here we had 50,000, okay, and then here maybe we have 30,000. However, in this 30,000, right, on this 30,000, no, okay, let me get that one straight again. Let's say accumulated depreciation was 50,000 at the beginning, and then we have depreciation for the year. which was 30,000, right? However, we sold an asset that was maybe worth 10,000 and it had an accumulated depreciation of 8,000, right? Including the depreciation that you calculated here. So what happens is that if now you are calculating the accumulated depreciation at the end, right? You're gonna have to take the 50,000 and then you plus the 30,000 and then you minus the 8,000. Sorry, you minus the 8,000. So the 50,000 is coming from the accumulated depreciation at the beginning of the year, and then the 30,000 is coming from the depreciation for the year, and the 8,000 we are minusing it as coming from the accumulated depreciation of an asset that was sold, right? Why do we exclude this accumulated depreciation? The reason we exclude it is because since the asset is no longer with us, we are not going to include the depreciation or the loss of value of an asset that does not belong to us. It's no longer our business because we sold the asset. But now one would ask it, it's okay, why do we exclude the 8,000, right? Because the asset is not with us, but under depreciation for the year, we include the depreciation for an asset that was sold. That's a good question if you're thinking about that. The reason is because depreciation is an expense. An expense is a commitment of a business for that current financial year, right? For that financial year. So now, if we incur an expense, we have to always include it in our books because we are the ones we incurred the expense. So the 3,000, which was the depreciation for the year, which was the depreciation for the in that year for an asset, right, that was sold, it has to be included because we incurred that expense. But the 8,000 now, since an asset does not belong to us, we cannot carry on recording the accumulated depreciation because as not the asset is no longer in existence, it does not exist in our books anymore. Hopefully that makes sense, guys. And then going back now to what you call going back now to our balance sheet. Okay, we discussed this. So if you add your fixed or tangible assets and then your financial assets, now what are your financial assets? Here we're looking for fixed deposit. I'm not gonna get too deep into that, but one thing to note here, guys, is that um in your fixed deposit, right? Let's say we have a fixed deposit of 50,000 and 30,000 of the fixed deposit is maturing in the next 12 months, right? It's maturing next year. We'll have to minus the 30,000 and put it under cash and cash equivalent. Why do we do that? Remember in the beginning, we discussed the definition of non-current assets, that these are the assets that cannot be or are not going to be converted into cash in the next 12 months. So if the 30,000 or the portion of the fixed deposit is maturing in the next 12 months, it does not meet the definition of a non-current asset anymore. Therefore, it's supposed to be excluded here and then put under the current assets, because the current assets means the definition is it refers to assets that are already in cash or are going to be converted into cash in the next 12 months. So that money or the portion of the fixed deposit that is going to be maturing in the next 12 months, it satisfies the definition of current assets. Therefore, it has to be included under cash and cash equivalent. But more on that later on. So you're gonna take your fixed deposit minus the ones that is maturing in the next 12 months, and then you get your total and put it here. And then your this plus this, it should give you your non-current assets, right? Okay, cool. Now we have current assets. Now inventories, we have a note for inventories, but it's good for you to know it, but it's never assessed. I have never encountered a question paper where an inventory note was assessed, but let's go through it and check it out on what's going on there. So it's note number 4. Okay, so here we just have trading stock plus consumable stores on hand. That's just it. You just have to know, if you see trading stock, you add it, and if you see consumable stores on hand, you add it. It's easy for people to actually forget this one, right? It's easy for people to actually forget this one, but that's fine though. Okay, another thing here that you have to note, right? Okay, this trading stock, they tend to get adjusted. How so? What do I mean by that? Now, it can happen that, let's say, at the beginning of the year, right, a person who was assessing the trading stock um, came into conclusion that our trading stock is worth 50,000. Okay, if our trading stock is worth, he's saying that our trading stock is worth 50,000, but another assessment was done only to find out that our trading stock is worth 60,000. So now, how do we account for this, right? So this is how we account for this. So you're gonna have to take the 10,000, which is the difference between the 60,000 and 50,000, as regarded as trading stock surplus. Trading stock surplus. Hopefully, you guys know about this. So it occurs in a situation whereby the actual value of trading stock is more than what it was initially classified as. So as trading stock surplus, so under your is going to be recorded in your what you call in your income statement and other income, operating income. It's going to be 10,000 trading stock surplus. And then in our trading stock now, if the 50,000 was already there, you're just gonna open your 50,000 and then you add the 10,000 and then you get your 60,000 here. All in all, it's good for you to show your calculations on how you got the 60,000. So the 50,000 was the initial assessment and the 10,000 came from the trading stock surplus, and then you're gonna get your marks here, and then 60,000, that's another mark here. And then for consumable stores on hand, there's also an adjustment. Adjustments can also be made, right? And then if you take this one, you get your inventories. That's your total inventories, and then you go ahead and excuse me, you go ahead and put it here, right? Okay, now we have trading other receivables. Guys, this one is a simple one. Make sure that you get your marks here, but it's easy to lose marks. I'll show you where. Okay, so it's note number 5. So here's how the table works, right? You have your trade debtors. The trade debtors are oftenly given out. So we have adjustments. You have to take your thingy, your trade debtors, and then you minus your bad debt. Let's say maybe there's a bad debt that occurred during the year. You're gonna have to minus it, and then you find the difference, and then you put it here, right? And then you're gonna have to minus your provision for bad debts, right? If you don't know what a provisions for bad debts is, provision for bad debts is the money that a business puts aside, right, as an allowance should a specific debtor not pay the debtor. So why do they put it aside? Before a debtor is classified as a bad debt, right, there have to be provision first, like that we are not sure that this debtor is going to pay their debt, or is going to settle their account on time, or that they are going to settle their account actually. So if we are not sure, it's a 50-50 situation. Now we're just gonna say we are going to put this money aside. It's just for provision should they not pay their debt, right? This is their allowance. So it's usually given in a percentage of the debtors. Let me say, maybe sometimes they say, okay, the provision for bad debts was adjusted to 5% of the trade debtors. So you're just gonna take your trade debtors times the 5%, and then you put it here. You're gonna have to minus it, and then you get your net trade. Guys, take note of this word. The net trade is very important, because most of the times, if you are given in your pre-adjustment net trade data, you don't have to do all of this, right? You just take the net trade, and then you gonna add the expenses prepaid, the income accrued or receivable, SAS, only if the company overpaid, only if the thing that the account is overdue, not overdue but overpaid, right? And then you add all of this, and then you get your total, and then you put it under trading other receivables. So guys, hopefully you guys don't forget that one. Now we are moving to cash and cash equivalent. Now cash and cash equivalent, guys, is easy, straightforward. Make sure you totalize your marks on this one. You're gonna take your fixed deposit. Remember, we discussed on this one, right? Only if it's maturing in the next 12 months. Okay, you take your savings account, take your bank, Note here, only if it's a debit balance. If it's a credit balance, that means it's an overdraft. Right? We'll discuss on overdraft draft later on. And then you take your cash float and then you take your petty cash and then you add it up and then you put it here. Excuse me. You're gonna put it here on your cash and cash equivalent, and then this plus this plus this, it should give you your total current assets. Now, non-current assets plus current assets is gonna give you your total assets. Remember that one now. Now we'll be dealing with equity and liability. So equity and liability is straightforward, guys. It's straightforward. Just make sure that you totalize your marks here. So now we have shareholders equity. We have under shareholders equity, we have two components, which is ordinary share capital and retained income. Ordinary share capital, this is the account whereby we record transactions that concern issuing of shares, the purchasing of shares. So let's say someone invest in our business, right? So basically, let's say we issue shares, right, to the public. If we receive the money, if somebody out there buys the shares and we receive the money, this is the account where it will be included. This is where the account where that transaction is going to be recorded. And then the retained income now. The retained income, it refers to income that is left after the business has paid all their expenses, has paid SARS, and has issued dividends. So after that, the money that we're left with is the retained income. Okay, now, but let's start with note number 7 now. Note number 7, what is going on in note number 7? Okay, note number 7, we have this one is heavily assessed, guys. Like, make sure that you know this one by head. Okay, I'm gonna start by authorized. Remember, authorized is the maximum number of shares that a business can issue. So you're gonna say number of authorized ordinary shares, and then you just state it there. I doubt you get an answer for that, but it's important for you to state it there. And then now, here we have issued. Here we have the value of the shares now that are concerned in the transaction. So we have ordinary shares in issue at the beginning of the year. It's usually given here. You're just gonna state the number of shares and then the value of the shares. Additional ordinary shares issued during the financial year at issue price of each, right? So let's say now the business issued shares of, let me say, 10,000 at how much? At 5 rand each, right? So what you want to do is that you take this 10,000 times 5, and then you're gonna get your 50,000 here, and then you put it there, right? It's always it's always positive, guys. So you shouldn't put it in brackets. You leave it like that because we are just increasing the value of our ordinary share capital account. And then now we have ordinary shares repurchased. So ordinary shares repurchased, it refers to the shares that a business repurchase back from the shareholders, right? So you're just gonna put the amount of shares here that were repurchased, and then remember, guys, to put the repurchased shares in brackets, and then you times it by the you times it by the average share price. Average share price, guys. With the average share price, the way you get it is that you add the value of the shares that are in issue, divide by the shares that are divide by the number of shares that are in issue, and then you get your average share price. So it can happen that sometimes they'll be like, the business repurchased the shares for 10 rand, right? This 10 rand is the repurchase price. First of all, this repurchase price, like, okay, here's how the whole shares work. So what happens is that that two goals that one wants to achieve when they invest in a business, right? One is capital gain and another one is dividends. Like, those are the two source of incomes from that you get, not source of income, but those are the two benefits that one gets when they invest in a company. So capital gain it simply means like it's just an increase in the value of the shares, right? Let's say you bought shares that are worth 5 rand. Let me say that were worth 5 rand maybe 5 years ago, and today they're worth 10 rand. The 5 rand increase is what we refer to as a capital gain, right? And dividends is what the business um compensate the investors for investing in the business, right? So remember, guys, investing in a company or business is a risk. So you have to be compensated, right? So the compensation, the way it works here, it's in a form of dividends. Okay. So now let's say now back to the average share price now. Let's say now uh the let's say now okay, let's say a business is like, no, we want to repurchase your shares actually, but we are offering 15 rand. So the way it works is that in their books, they're not going to record the whole 15 rand, but they are going to find the average share price first. So the way they find the average share price is just to take the value of the shares that are in issue, divide by the number of shares that are in issue. Let's say in this case, just for example, as 10 rand. That's 10 rand, right? So the 10 rand is going to be our average share price, and they're just going to take the number of shares that were repurchased times 10 rand, and then you put it here, right? Now, what's going to happen to the 5 rand? The 5 rand now, the company will have to use its own money to fund for this repurchasing, right? That's going to be included in the next note. Just keep note of that one. So, but this 5 rand now, you shouldn't be included here because it does not like now you are minusing something that was never accounted for. Right? Remember, we can only in accounting we can only credit something that was initially debited at first. Okay, that when we are reversing transactions, basically that's what is happening here. Basically, here we're just reversing the transaction. We issued shares at the beginning. Now we are repurchasing those shares again, right? So now it's just a matter of buying back the shares that we had that we sold you. So we can only record the repurchase at an average share price, right? You're just gonna take your ordinary shares and then you times it by the average share price, and then you put it in brackets, and then if you take this plus this minus this, and then you're gonna get your ordinary shares in issue at the end of the year. This is the amount that is going to be put under the ordinary share capital in your balance sheet, and here you're gonna get your shares that are in issue at the end of the year, basically by taking the shares at the beginning plus the issued shares during the year minus the repurchase, and then you get your total. Yeah. Okay. It's also important here, guys. Maybe if you are required to calculate the final dividends, so you're gonna if you cannot calculate the final dividends, yeah, you're gonna have to use the shares that are in issue at the end of the year. So you can always refer to this note. So it's important for you to get this information correct, because if you don't, next thing you're calculating your final dividends and you're stuck because you didn't calculate the shares that are in issue at the end of the year, or you're gonna get it wrong eventually if you get this one wrong. So we are done with the ordinary share capital. Right now we are moving to retained income. Retained income. This one is also a straightforward note. There are a lot of marks that can be gotten here. Like you can get marks like for days, man. Like it's so simple. So basically, you're gonna start with your balance at the beginning of the year. If it's not given, you will get it. Like there are many ways to get it. There's sometimes whereby it's not given, but you're given everything else, and then you're gonna have to work your way from the bottom to up. Like take this one minus this one. I mean, take this one plus this one plus this one minus this one, and you get this one. But let me not confuse you now. But balance at the beginning of the year, you take it and put it there. The net profit after tax for the year. When you're doing your statement of comprehensive income, also known as income statement, right? You calculate your net profit after tax for the amount that you calculated them, you have to put it here as it is. So even if it was wrong then, if you put it here as it is, you're gonna get a mark for that one. And then we have repurchase of ordinary shares. Remember when I told you that uh excuse me, remember when I told you that any amount that is access to the average share price, right, is going to be accounted for in your retained income. This is where now you account for it. So remember, it was 10 rand, right? The average share price was 10 rand, and with the company bought back shares for 15 rand. So the 5 rand difference now is going to be accounted here. Sorry, it's going to be accounted here, right? You're just gonna take the number of shares times the 5 rand, and then you get it, and then put it inside the brackets. And then now we have dividends on ordinary shares, right? Dividends on ordinary shares compensate of two things, as what you call the interim and the final. Here they say paid and recommended, but you can just simply say interim and the final dividends. The interim dividends is the dividends that we declare during the year, during the financial year, and the final dividends is the dividends that we declare at the end of the financial year. So guys, here it's important with this one to take note of the date. Right? Why are the dates useful here? The reason the dates are useful here is because sometimes we declare we declare the interim dividends after or before we repurchase shares. So if we repurchase shares, right, those shares are not entitled to the interim dividends. Therefore, they have to be excluded here. So you have to know the amount of shares that were in issue when the interim dividends was declared. So date will help you so much here. So you have to take note of the date. You have to take note of when the interim was declared and how many shares were in issue when the interim was declared. Same thing goes for final dividends, and then you take them and then you add them, and then you get your dividends on ordinary shares, and then your balance at the end of the year is basically the addition of this minus this, and then you get your total here. Hope you guys understand that note. And then now we are moving to non-current liabilities. This one is simple, guys. Non-current liabilities, it's so simple. Usually they want to make it complicated by including a repayment, by including the interest and stuff like that. So, but it's just simple. So here's how you get it. You have to take your loan plus interest minus repayments. Okay, usually the loan is given the pre-adjustment, and then the interest they're gonna tell you is okay, 5%. The interest is capitalized on 5% of the loan, and then when you calculate that 5%, you have to add it here, and then you minus the repayments. Now, first of all, I have to discuss with you what are the non-current liabilities and what are current liabilities. So liabilities are differentiated into two, right? Not differentiated, but they are divided into two components. We have non-current liabilities. It refers to the liabilities that are not going to be repaid in the next 12 months. Okay? And then current liabilities refers to the liabilities that are going to be repaid in the next 12 months. Okay. The reason we're minusing the repayments here is because we are going to repay this the portion of the loan in the next 12 months. So therefore, it has to be included under the current liabilities because it does not satisfy the definition of non-current liabilities. Hope you guys get that. So remember, you take this plus the interest minus the repayments, and then you get your total here, right? And then for current liabilities, it's usually more. I don't know why in this case it's less, but and current liabilities here, we're talking about your current portion of the loan. You get it from here. You take the amount as it is, and then you put it here, even if it's wrong. But if you take the same amount and put it here, you're gonna get a mark. And then you have your trade and other payables. Here it has a note actually. Let's say number 9. It's note number 9. Okay, you have your trade creditors, and then you have your expenses accrued or payable. I don't know if you guys know the definition of accrued and payable, but basically I'm just gonna simplify for you. These are the expenses that we have incurred, but we haven't paid for it. For example, let's say we have we pay electricity 12,000 like per year, right? But we didn't pay that 12,000, right? Since we still have to pay for it, it's going to be included here in expenses accrued. And then we have your income received in advance. If we receive an income while we haven't provided the service that we're supposed to provide to the customers, right? That paid this amount of money, we have a right, or they have a right to claim that money back. So since they have a right now, that means again we are obligated, or we are enforced by the law to pay back the amount of money that they paid in advance if they want it back. Therefore, it has to be included in our trade and other payables. It is payable should the customer wants it back. So that's what I'm trying to say. And then you have your creditors for salaries and wages. Okay, let's say you didn't pay your salaries and wages on time, or you didn't pay for this year. It has to be included here. You have your unemployment insurance fund, medical aid, and pension fund. Okay, you include it here. And then here it says, do not forget to add the deduction from the salary wage. Oh, yeah. So, guys, here basically when you're calculating your salaries, right? Sometimes they can say that they can give you the net salary, and they give you the deductions and the contributions and stuff like that. So when you are calculating each, as in the business, we're only interested in calculating the gross profit. So basically here this note is telling you that if you're given the net salary, just add back the deductions and also the contributions. Here there's a little bit of mistake here. These three components, which is SaaS, right? They're not supposed to be included here, but they are supposed to be included under 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 current liabilities. That's why I was surprised that why is it small. So you're gonna have to put your SaaS here. Should you have underpaid your tax, right? You have to put it here. SaaS. Is it SaaS payable, or you can just put SaaS and then you put the amount that is payable or that is due to SaaS, and then you also have shareholders for dividends. So and have usually as the dividends that is declared at the end of the year. Remember, if we declare our final dividends, that when we declare them, we are going to make the payments in the next financial statements. So therefore, it's a liability for us since we're not going to pay for them this year. So you're gonna have to put your what you call shareholders for dividends. Just put your final dividends here, right? And then another thing we have under current liabilities are your what you call as your your bank overdraft. So bank overdraft, it refers to a situation whereby a business or someone actually have used, let me say, actually, let me not say overdue because I'm not explaining anything, but let me say now, let's say a business is in a situation whereby they want to make a transaction that is worth 50,000. Okay, however, in their account they only have 49,000. So now the transaction will go through depending on what type of account they are using. Like usually you have to apply for the bank overdraft. So let's say they have 49,000 available in cash, I mean in the bank, but the transaction is 50,000. So instead of the I mean instead of the bank declining the transaction, they'll just, okay, the transaction will go through the 50,000. However, and this 50,000, right, you're gonna have to owe us the 1,000 rands, which is the difference between the 49,000 and the 50,000, right? So this 1,000 rands is now what we refer to as bank overdraft. But this bank overdraft now, they can also charge you interest on it. So yeah, just be on the lookout for that one. If they say, maybe let me say they say 10% of on bank overdraft was charged, so you're gonna have to calculate the 10%. Just say 1,100 times 110%, and then no, it's 1,000 times 110%, and then you get your 1,100, and then that's what you're gonna include under your what you call, that's what you're gonna put under your cash, I mean your bank overdraft. So now if you add all things, and then you get your current liabilities, and then you get your non-current liabilities, and then you get your, you also take your shareholders equity, you add this plus this, no man, this one plus this one plus this one, you get your total equity and liability. And remember, guys, your total equity and liabilities, they should always be equal to your assets. So for you to know that you did the right thing, your assets are always, or they're supposed to be always equal to your equity and liability. So guys, that's the end of the lesson. If you guys are interested in joining Japanomics tutorials, just make sure that you join the group, or you message, or you private message Remofilwe. The numbers will be left, or they will be put under the description of this video. Thank you so much, guys, for joining or for watching today's video, and hopefully you guys join tomorrow's class. Is it tomorrow? Yeah, tomorrow's class by 8 o'clock. If you haven't gotten the link, just make sure you private message Remofilo as soon as possible, and it will send you the details of the class. Thank you so much. Hopefully you guys enjoyed and you have gained something out of this lesson. The next lesson that I'm going to record is going to be on cash flow statement. So stay tuned for that one. We'll share the information in the group. We'll share the communication. Have a good one, guys. Good night. Goodbye.